So next topic we are going to cover is unapplied payment. I'm not sure if you have actually heard of it. It is not commonly used in QuickBooks, but it is a feature that QuickBooks automatically creates. We don't need to do it. It is not done manually. It is an automatic feature in QuickBooks. How it works is, so for example, you have a vendor bill. Okay. So the vendor bill, you receive that bill on, let's say, 1/30/2025 for $100. Okay. But you book that as a bill, right? That's simple. You go to vendor, you create a bill, and then you save it. It will show in your AP as well. But what if you make that payment on, let's say, 12/30/2024? So you paid that invoice already in advance in the last month or the last year. So what will happen is QuickBooks will see that there is no expenses or bill booked on December 31st because it's going to close the books for a month or for a year, whatever the period is, and it will not see as an expense or a bill for which we made that payment. Because what we did is when we saw that $100 payment going out, we actually matched it with this open bill, which is correct, right? There is no wrong of matching this payment to this open bill. But what will happen is, because this was in a different period that you received the payment or you made the payment, and the invoice was on a different period, it will create an unapplied cash expenses or unapplied cash payment income account in QuickBooks. What it will do is, in P&L, how it will show. So it will show in the P&L as a cash applied payment, either expense or income, and it will show as 100 in P&L. In the next month, in January, so this is for December, it will show cash applied payment income as positive 100. So it will zero out in two different periods. But this is actually basically a temporary account which QuickBooks has used. The logic why it is using it, because QuickBooks doesn't recognize a payment which is made for the future bill as of today. So it's not going to recognize that as an expense because we have not booked as an expense. There is a bill, but it's sitting in the next month. The expense will be shown in the next month itself because that's the period for the bill is for, right? So then it will going to create a temporary adjustment in the P&L to actually adjust that balance. Okay, understood? So that's why we are using unapplied payment income. Now, what is the right way to do it? Because I don't want to see an unapplied cash payment income in my P&L at all because of this issue. It's a genuine issue which is fine, but I still don't want to see it. So what I'll be doing in that case? So what I'll do is I actually will create an accrual. Either an accrual if it is a bill for the month of December. So that Jan invoice that we received on 1/31, if it is related to December, then I'm going to create that as an accrual. If let's say that this is not an accrual actually, so what I'm going to do is I'm going to, whenever I see that $100 going in my bank, I'll book it as a prepaid expenses. Okay, because you actually made a payment in advance for a future invoice. So it's going to be adjusted through a prepaid expenses. Now my balance sheet will show prepaid expenses as $100 on 12/31/2024. And I still have that invoice as open because I haven't matched it. So what I'm going to do is I'm going to reverse this entry into the future month. So what I'm going to do is vendor account debit to prepaid expenses. So now the prepaid expense is 0. Now I have a $100 credit in my vendor account because I debited that. So then I'll match this vendor credit with the open bill that I have. So that 100 and 100 gets matched. So then it will be zeroed out. I don't have any unapplied cash payment income in the balance sheet or in the P&L for any of those two months. So that's the right way to do it. Anytime you see this transaction appearing in your P&L, and that this is because of this example that we discussed. Understood? So this is same. We took an example for vendor, but it will also happen for the income side as well. If you have an invoice for which you receive the payment in advance, and if you are matching it with the future invoice, it will again create the unapplied cash payment income. What is the right way to do it? You need to create same. Either we'll create a prepaid expenses, but because for the expenses, or we'll create for the deferred revenue. Same for the revenue side of things, and then we'll adjust through a journal entry. So this is actually happens through the journal entry. Whenever you select a vendor account or a customer account in a journal entry, you actually need to add the name of the customer or vendor mandatorily. If you don't do that, then it will not create the entry for you. So the moment you add the name of the vendor, it will automatically create a vendor credit in the vendor account itself.